Hello everyone and welcome to Financial Accounting. In this video I'm going to be going over Chapter 11 that covers bonds payable. And bonds payable is still a continuation of liabilities. So we're going to be mainly focusing on bonds payable, which is another form of long-term liabilities. So what is a bond? A bond is a form of interest-bearing note. Like a note, a bond requires periodic interest payments with the face amount to be repaid at the maturity date. So in a bond, the company would borrow some money, and then the bondholder would receive interest on a regular basis, and then at the maturity date, the company is going to pay back the face value of the bond. So we'll get to know all of these terminologies shortly. So as creditors of the corporation, bondholders or a bondholder claims on the corporation's asset rank ahead of stockholders. So if I'm a bondholder, and the company that I'm investing in by buying its bond, or investing through its bond, I have priority in the case that this company files for bankruptcy, ahead of the stockholders. So a bond issue is normally divided into a number of individual bonds. The face amount of each bond, called the principal, is usually $1,000 or a multiple of $1,000. The principal must be repaid on the dates the bond mature. The interest on bonds may be equal or may be payable annually, semi-annually, or quarterly. However, I want to make things very clear for you that the interest rate that's always mentioned on the bond face is always an annual rate. But we have to convert it if it's semi-annual or quarterly. So if it's semi-annual, we divide it by 2. If it's quarterly, we divide it by 4. But the interest rate, whenever it's written down, it's always written in an annual rate, even if the bond says it pays semi-annually or pays quarterly. So most bonds pay interest semi-annually, which is twice a year. In this case, we have to divide the interest rate by 2. The underlying contract between the company issuing bonds and the bondholders is called the bond indenture. And I want you to remember this term, bond indenture, because there's something called bond indenture and there's the debenture. So the underlying contract, the agreement itself, is called the bond indenture. The two most common types of bonds are term bonds and serial bonds. When all bonds of an issue mature at the same time, they are called term bonds because they only mature at one time. If the bonds mature over several dates, they are called serial bonds. So they don't mature all at the same time. There's like some kind of serial payments. There are also a variety of more complicated bond structure. So there's something called convertible bonds, and there's also something called callable bonds. So bonds that may be exchanged for shares of common stock are called convertible bonds. They can be converted from a bond, which is a liability, to a common stock, which is an equity. Bonds that may be redeemed by the corporation prior to maturity date are called callable bonds. So if the company that issues the bond gives itself the right to buy it back from the bondholders, this feature is called callable bonds. It's not a very good feature for the bondholder because there's no guarantee that the company might not call it back and give them back the money. Usually they give them back the money with a premium. So there's an extra cash on top of the face value. But still, again, it makes the bondholder not in security of being able to keep the bond until maturity. So now let's talk about proceeds from issuing bonds. So when a corporation issues bonds, the proceeds received for the bonds depends on 3 factors. The face amount of the bond, which is the amount due at the maturity date, which is how much the company is going to pay the bondholder at the date of maturity. The other factor is the interest rate on the bond, which we call it the stated rate, and the market rate of the interest for similar bonds, which is similarly the market rate that other bonds are issued for. So we have to be very clear about there are 2 types of interest. There's the interest rate that is mentioned on the bond, that's the stated rate, and there's market rate, which is the rate in the market, which has nothing to do with what's going to be paid out of our bond that we focus on. However, it has an impact on how we calculate the value or the selling price of the bond, and also how the interest expense is going to be calculated later on. So the face amount and the interest rate on the bonds are identified in the bond indenture. And the bond indenture, again, that's the bond agreement. The interest rate to be paid on the face amount of the bond is called the contract rate or the coupon rate. Or sometimes I prefer to call it the stated rate. So remember, the interest rate that's mentioned on the face amount or on the face of the bond, that's called the contract rate or the coupon rate, or sometimes I like to call it the stated rate. The market rate of interest, sometimes called the effective rate of interest, again another name, sometimes they also call it the yield, is the rate determined from sales and purchases of similar bonds. The market rate of interest is affected by a variety of factors, including investors' expectations of current and future economic conditions. In some cases, the contract rate is the same as the market rate. In other cases, they might be different. The contract rate might be lower than the market rate, or the contract rate can be higher than the market rate. By comparing the market and the contract rates of interest, it can be determined whether the bond will sell for more than, less than, or at the same face amount. So we'll see how this works. So as you can see here, we have three scenarios, and I'll start with the middle scenario where the market rate is equal to the contract rate. In other words, our bond, or the bond that the company is issuing, pays 10%, and the interest rate in the market is 10%. So in this case, the selling price is going to be the same as the bond face value. So the selling price is going to be the same as the face amount. Why? Because our bond is very similar to the market. So it should be paid based on its face value. It should be sold, based on its face value. So it would be sold at the face amount. Let's assume that the market rate is better than the contract rate. So the bond that's issued by the company pays 10% per year. The market rate is 12%. So in this case, the market is better than the bond. So why would somebody invest in the bond, knowing that the bond would pay, or this particular bond would pay less interest compared to the market? So the company would have to find some kind of incentive for the bondholders to invest in this bond, and this incentive would be selling the bond at a discount. So instead of selling it at the face value, they're going to sell it, let's say, at a lower than the face value. Let's say $900. So it's a $900. You're going to receive the 10% interest, which is 2% less than the market, but at the same time, you're going to get a $1,000 maturity date. So we are compensating you with for the lower interest rate by allowing you to buy the bond at a discount or a price that's less than its face value. So the selling price in this case is less than the face amount, and it would be sold at a discount. What if the market rate is less than the contract rate? So the bond has a higher interest rate compared to the market. So the bond still pays 10% per year as interest, but the market interest rate is only 8%. So the bond issued by the company has an advantage compared to the market. And because it has an advantage, it's going to be sold at a premium. And by premium, we mean that the selling price would be more than the face amount. So if somebody wants to invest in this bond, they have to pay more than the $1,000, let's say $1,100. And why they're paying this premium? Because it pays interest that's higher than the market. So they're actually getting some benefit of this interest. So if the market rate equals the contract rate, bonds would sell at the face amount. And that was the first scenario that we started with. If the market rate is greater than the contract rate, the bonds will sell for less than their face value. And in this case, we call it a discount. So the face amount of the bond less the selling price is called a discount. If the market rate is less than the contract rate, then the bond will sell for more than their face value. The selling price of the bonds less the face amount, in this case, is called the premium. So please make sure that you understand the difference between the discount scenario and the premium scenario. And I think it's just very simple by comparing the market rate to the bond contract rate. If the bond contract rate is less than the market rate, then we have a discount. If the bond contract rate is higher than the market rate, then we have a premium. The price of a bond is coded as a percentage of the bond's face value, and that's some kind of language that is used in the bonds world. So a $1,000 bond coded at 98, and we don't call it 98%. It's just 98, could be purchased or sold for $980. So even though it's 98%, but we just call it coded at 98. So we know that this is a bond that's discounted. And the amount of discount is only 2%. So it's sold for $980. On the other side, we can see bonds coded at 109, which means 109%. However, the percentage is not written there. It could be purchased or sold for $1,090. And how we get it? We take the 1,000 multiplied by 109%, and that would be 1,090. So let me stop here. In the next video, we'll continue discussing these kind of bonds and the accounting treatment for the issuance of the bonds.